The nightmare returns. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, Americans are in panic mode as the next subprime crisis begins. And this time it's not in the real estate market. You're not going to believe where this is originating and just how devastating the impact is going to be, because unlike last time that hit the major banks, this time it's going to impact not just the small and mid-sized regional banks, but credit unions as well. Plus, we're seeing more signs that the U.S. economy is running out of money at the same time that the U.S. labor market, that many experts and political elites said is immune to a downturn, is about to see a surge in unemployment claims. And if you're wondering what we're doing at the People's Bank of China today, well, I'm going to show you firsthand that they made a major mistake last night. Plus, we have a sponsor for today's show. You might remember QU. They're the new age media entertainment company, and the last time we featured them on the show, their stock jumped 40%, and they've got some big news and some even bigger news coming that you'll want to stay tuned for. And we're going to show you this time why I think their stock is poised to move as much as 60%. Stay tuned to the end of the show, or check out the pinned comment or description for more information. Now let's head to Bloomberg, where we go looking for more money. As we see WeWork shares sink after reported plans to file for bankruptcy, and yet here we have a double-edged story, because what do we know in the commercial real estate market? That prices are coming down, and here we see a company who once was one of the darling companies just poised to explode. The valuation for it went through the roof, and yet today they're running out of money in a major way. A spokesperson for the company said it would not comment on speculation and point to a Tuesday filing which said WeWork had been holding discussion with creditors about improving its balance sheet and taking steps to rationalize its real estate footprint. On Monday, the company entered, here we see lack of money, a forbearance agreement with its creditors, which will end in 7 days. So once again, we see continued signs when companies or people are going into delinquency and then eventually default. It's a sign. We've noted this is happening in China, which we're going to look at more in a little bit. And here it is in America. A major company is just simply out of cash. And speaking of out of cash, well, the U.S. government seems to need even more. And yet the U.S. slows its pace of increase in quarterly long-term debt sales. In fact, this was bigger news today than the fact that the Federal Open Market Committee decided to hold rates at current levels, because there was a big fear that increased issuance of U.S. Treasuries was driving rates higher. Now, we know that that's not how the system works at all, but there's been a big concern about this rapid move higher at the long end of the curve. And sure enough, not only did the Treasury respond by making some adjustments here, but of course the Fed, as we knew, was going into pause mode because they're scared as well. And compared with August, the key difference this time was slower pace of increases in the sale of 10 and 30-year securities, with 20-year bonds kept unchanged, this giving the Treasury bond market a sigh of relief, as Treasury officials said the shift was small and some dealers expected an even bigger slowdown in longer-dated issuance. Even so, those with securities rallied on the news, with the 30-year yield down the most. And in its guidance to officials, the Treasury Borrowing Advisory Committee, a panel of bond market participants, said that there's been some waning in appetite for U.S. debt. Now, this isn't entirely true, because there is plenty of appetite for shorter term T-bills. In fact, there's almost an insatiable appetite for collateral right now. And sure enough, they validate that. Here you see the PBOC noted there's more liquidity and demand for securities maturing sooner than 10 years. And again, this is a collateral issue of the system. One of the problems is when the U.S. government issues new debt, they issue it as T-bills first, and then as those bills renew and come due, they mature them out into longer term securities. And so the problem is, right now, the global financial system is desperate for T-bills. They want this short-term collateral, and the problem is the U.S. government could give them a ton of it. They just are choosing not to, but finally, they're bowing to the pressures of the market and this move higher in yields. So the Treasury is bowing to it, as is the Fed. We got both of them then on pause because what they need to see is the market stabilize here, and that's just exactly what the dealers wanted them to do. And so now we head over to China. Some big news there. Let's take a look. As China's property sector loans contract for the first time on record. So here we see at a time when the U.S. government is pulling a massive amount of money out of the U.S. economy to fund its deficits, this is having a double whammy effect on the economy that's already slowing because the U.S. government competes with the private sector. Now in China, what have we noted here is you see that loans are contracting for the first time on record. Now this is something that's happened in the U.S. before, particularly in the commercial industrial space, that we note that during recessions, we typically see a contraction in lending. Of course, what this means is money is being destroyed at a faster pace than it's being created, which in a debt-based economy is a huge problem because then it means asset prices must start to collapse. And sure enough, that's exactly what we're seeing in China. The outstanding amount of loans in the property sector fell 100 billion yuan or 53.19 trillion yuan at the end of September compared with a level of year earlier. That's the first year-on-year drop in the data going back to 2005. Outstanding mortgages declined by 490 billion yuan to 38.42 trillion during the same period, the second straight quarter on year-on-year contractions. So here what we can see and expect is an absolute collapse in prices. So prices have to shrink if you don't have enough new debt and loans to support the existing values. And sure enough, that's exactly what's happening in China. And we know that as their property sector starts to contract, it's going to put massive pressure on the banks, and that's going to turn into an all-out financial crisis, not just in China, but of course we know here in the U.S., the small and mid-sized regional banks are already insolvent. As China's ongoing housing crisis remains a serious drag on the economy, even though other sectors such as industrial production have recorded some improvement in recent months, but we've noted that that's going to roll over and head lower. The vast real estate sector contracted 2.7% in the third quarter, the biggest quarterly drop this year. Of course, on back of that, we've noted that Chinese consumers just don't want to buy homes because they see not only the property developers insolvent, they're seeing price come down, and there's really no point in them buying because they also see beyond that demand at the factories from around the world is slowing down. And yet what we then see from the People's Bank of China is a massive policy mistake. And I want you to see this because central bankers, many people think that they understand how the global monetary system works because we put them in charge of it. And yet here's evidence that they have absolutely no clue how it works at all. As the PBOC drains liquidity in Signal, it sees rate surge as temporary. Now, what they did is they withdrew a net 109 billion of yuan via open market operation, and they see Tuesday's rate rise as a one-off. What they don't understand is what causes rates to go higher and why they made the absolute wrong move. Instead of pulling liquidity out of the system, they should be injecting liquidity into the system. Let's take a look. The withdrawal came even as funding conditions tightened sharply in recent days due to month-end demand, tax payments, and large government bond sales. So what does all that translate to is the financial system needed money. So if you think about it, why would rates rise if the financial system needs money? To get money into the financial system. That's why rates rise. Let's continue here. Still, the overnight rate had surged as high as 50% in isolated transactions. So there you go. The overnight rate went up. Why? To attract money into the system. And of course, that's what we know. And that sparked concern over a potential stress in the financial system. That is stress of the financial system. When a financial system is running out of money, and we know the global economy is doing that, but here you see an isolated case, rates in the short term went up to try to pull money into the system. And of course, what does the PBOC do? Just the exact opposite of what it should be doing. State broadcaster China Central Television blamed unidentified financial institutions. Well, because we don't want to blame the PBOC for disrupting the market on Tuesday. Some institutions with the aim of maximizing profits depend too much on rolling over financing, borrowing short and investing long, creating their own liquidity risk, which disturbs the market and creates a tense mood. Of course, what we could have simply said is the PBOC recognized that there was a big demand in the short term for cash and could have injected liquidity into the system and in turn made the whole thing worse. And one thing that's getting worse now is the U.S. labor market. And what do we know? Many political elites said this can't happen. Many experts said the labor market here is so strong that it can get through anything. We've been continuing to make the case why it was just a matter of time before the U.S. labor market fell apart. And today we get some signs that it is. As U.S. companies add fewer jobs than forecasted from the ADP data, as private payrolls rose 113,000 last month after posting the weakest advance in 2 years in September, according to ADP. The median estimate by Bloomberg called for a reading of 150, and so what you saw, at least after the report came out, is a negative reaction by the market. But we knew this was likely to happen. We've made the case before that the manufacturing sector tells us the direction of the U.S. labor market. Meanwhile, what do we hear from the political elites? It's all about the services sector. And no, it isn't. The services sector is great, but there's a lot of low-paying jobs compared to the manufacturing sector. And let's take a look. And here you can see the general activity indexes from the manufacturing sector of the Philly Fed against total non-farm. We're going to look at the non-farm pay report. This comes out Friday. Now we're going to trim this back here a little bit to cover out of the point of the pandemic, just so you can see the charts. And what I want you to know is that anytime the Philly Fed general activity index for the manufacturing sector drops below the black line, that's when it goes into contraction. What happens to red? Well, this is, of course, change in thousands of persons of the non-farm pay report. And sure enough, the manufacturing sector goes down and payrolls follow. And you see it over and over. You see it in the 70s, the 80s, the 80s again. How about the 90s? You got it. And dot-com bubble, it's there, as is the global financial crisis. And it just happens to repeat over and over. And we've noted here in recent times that the Philly Fed Manufacturing Index is turned back into contraction. We're seeing a continued slowdown in the U.S. labor market. Of course, again, policymakers don't see this. They don't understand this at all. And the ADP data showed further cooling in wage growth. And you know, we've been talking about how wage growth is going to slow here. We've made the case. And yet, what do we again? We hear from policymakers that wage growth is strong. It's going to drive a wage price spiral, that higher wages are going to lead to more demand and push prices higher. We said, look, you can give all the raises out you want, but in turn, what happens is you see that a lot of employers are cutting hours because they just don't have the work. But policymakers don't seem to get it. Workers who stayed in their jobs on average 5.7% median pay increase in October from a year ago. Meanwhile, for those who changed jobs, wages rose 8.4%, both with the slowest pace since 2021, and we made the case are going to continue to decelerate. And simply a matter of the fact that employers do not have enough money to continue to give out raises, and the reason why is the consumer price index is falling. If prices go higher, then they can give raises. But if it slows, well, guess what? Raises slow too. And sure enough, the evidence of that is pretty clear as we look at the consumer price index here shown in blue against average hourly earnings for production and non-supervisor employees, that in red both on a year-over-year rate of change. And right now, what do we know? The average hourly earnings are indeed outpacing the consumer price index. The problem is hours worked are getting cut so much that total compensation growth, as we've shown, is headed lower. But sure enough, as the CPI heads down, employers cannot give out those big raises anymore. And yet we're going to see further deterioration in the labor market and pay as manufacturing survey screams stagflation. Inflation accelerated, demand muted, and job cuts for the first time since COVID. And keep in mind, we don't see periods of stagflation that last very long. Simple reason is, and when you see periods of high prices and rising unemployment, well, guess what? When people go on unemployment, they make less money and they still have to pay for rent. They still have to pay for food and energy and their debt, leaving very little money, if any, for discretionary spending, and that causes a consumer price index to head much lower. Sure enough, we're going to see layoffs now start to surge. And again, nobody said this could happen. They said the labor market was strong. Even earlier surveys from the manufacturing sector said, you might remember, we're going to keep hiring. We're planning to hire. Well, that now has changed. After the unexpected rise in September, expectations were for October's manufacturing surveys to hold their gains around the 49 to 50 level, which means unchanged from the month before. And sure enough, S&P Global's U.S. manufacturing PMI printed 50 in final for October, meaning unchanged from the prior month. But the ISM manufacturing survey printed well below expectations, a 46.7. Now keep in mind, when you get to 45, that is recession level print, and all of a sudden, according to the ISM, we're headed to a recession much sooner than many of the experts said, because they're claiming maybe sometime in 2024, but we might be there by the end of the year. The PMI survey highlighted that demand conditions were historically muted overall, with firms downwardly adjusting their output expectations for the year and cutting employment for the first time since July 2020. We made the case here that when new order demand fell and backlogs got worked through, it was only a matter of time before employers started to cut heads, and sure enough, they are. The ISM warns that the October reading of 46.7 corresponds with a change of minus 0.7% in real gross GDP on an annualized basis, suggesting, as we've made the case, that GDP growth is going to slow, and meanwhile, new orders and employment fell as prices rose. And here we can see the current general activity index going back to the Philly Fed manufacturing survey against the 4-week moving average of initial claims. And sure enough, when you see a deceleration and a contraction in manufacturing output in the U.S. at every interval, what do you have? A rise in the 4-week average of moving claims. And sure enough, you see that now the Philly Fed is starting to head down. We know the ISM is validating that. The S&P Global is falling behind a little bit, but we'll catch up, and that means we should expect now in the weeks and months to come that initial claims should head higher. And let's take a look at some of the notes from the survey. As the October PMI data signaled stabilization in the U.S. manufacturing conditions amid a renewed rise in new order inflow, which is good, and firmer output growth. Demand conditions reportedly showed signs of improvement as customer interest revived, but this was once again largely focused on the domestic market as new export orders fell at a quicker rate, showing that global demand is indeed contracting. And here we look at the ISM data. Of our concerns were reports of dwindling backlogs of work. There you go. That leads to higher unemployment. Previous used to help support production, as firms also revised down their expectations for future output to the lowest in 2023. At the same time, manufacturers cut employment for the first time in over 3 years as workloads reportedly insufficient to warrant additional hiring or replacement of voluntary leavers. And on the price front, manufacturers saw sharper increases in costs and output charges as inflation regained some momentum. Higher oil and oil-derived input prices again spurred hikes as rates of inflation accelerated for the third month. But one thing we have noted is they haven't been able to pass those costs on. And now we get to the Americans in panic mode. You see the labor markets coming apart. You see that we're running out of money. You're seeing central bankers and even the government worried about higher interest rates. And now we're about to see a revival of the subprime crisis, but in a place few expected. As Americans panic search, quote, give car back as subprime auto loan delinquency erupts. Recent data from Edmunds reveals an unprecedented 17% of American car purchasers now have monthly car payments of $1,000, a significant increase from just 7% 3 years ago. The trend highlights the extent to which consumers, despite being financially stretched, are willing to take on massive auto debt in these uncertain economic times. And here we can see this is surge on the Google search engine as a recent percent of subprime auto borrowers at least 60 days past due on their loans rose to 6.11% in September, the highest in data going back to 1994. This is according to Fitch Ratings, and this is going to be huge. It's going to be disastrous, not just for the small and mid-sized regional banks that do car loans, but imagine all these credit unions. They're big lenders in the car space. None of them want their parking lots to turn into car dealerships for used cars, but it is coming because we're seeing money continue to dry up. But one thing we remain very bullish about, and we think money is going to flow into, and that is the stock for our sponsor QU. Again, they're a new age media entertainment company, and as I mentioned at the beginning of the show, the last time we featured them, the stock jumped 40%. We're making the case today based on not only the news, but there's some big news coming that you'll want to stay tuned for. But their stock, we think, is poised to go up by as much as 60%. Let's take a look because all their information is in the pinned comment and description below. Again, QYoumedia.com. You can find them on the OTC under QYOUF. And here we can see QU India, QPlay Plus expands connected TV distribution via global partnership with Kulida. And here you can see a company operating in India and the United States. And the India story is huge. We'll show you why in a little bit. Producing and distributing content created by social media stars and digital content creators has announced a significant expansion of its connected TV distribution for QPlay Plus and its featured channels via partnership with Kulida, a leading global smart TV OS brand. And you can find them on the TSXV under QU and on the OTC QB under QUF. Let's take a look at their stock because we zoom back to 5 years, they're sitting right above where their long-term trend, where buyers came in a long time ago. You can see what's happened. The stock has gone as low as 2 cents, but typically around 5 cents, up to almost 42 cents. If you can imagine that, it's sitting deep in the supply zone. We're making the case with the recent news that's coming. The stock's headed a lot higher. And sure enough, when we zoom into the 1 year chart, you can get a very clear picture of the supply zone. Every time it gets around this 4 to 5 cent zone, buyers step in. And during our last promotion, this thing jumped over 2 cents or about 40% move. We think it's still going to make a 60% move. You see up here at 8 cents. This is the sell zone. This is where sellers are selling the stock. This is where buyers are accumulated at 5. We believe that the next move is up to 8 cents, and that would realize a 60% move in the stock. Let's look at why. Because India's a major gaming growth market, and they're projected to rapidly grow in size, nearly tripling from 2.6 billion to 8.6 billion between 2022 and 2027. And as we've noted, QU Media on the TXSV under QU and OTC QB under QUF is an entertainment company with a focus on bringing creator-led content to the Indian market. And while the business already owns a slew of successful TV channels across the traditional and app-based platform, it took the jump into mobile gaming space at the start of the year, and that could be the catalyst that sends its stock much higher, as we're noting potentially a 60% move. You can see as we zoom into the 90-day chart, the volume profile sitting right at about 6 cents. You can see buyers accumulating at 6 cents and below, sellers above at 8. And currently, as the time we record, this stock was trading around 5 cents. Again, setting up the stage for a 60% move in the upside. But as with all companies we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.